So, what is the absolute best way to invest $100 online? It's probably one of the most common questions people ask. Well, 4 years ago, someone decided to stop guessing and actually find out by running a real world experiment. They took 5 different types of investments, put $100 into each, and just let them run. So, let's dive into this little financial bake off and see what happened.
Here's our game plan for today. We'll kick things off with the rules of the experiment. Then we're going to meet our 5 contestants: individual stocks, REITs, the wild cards, crypto and gold, and good old index funds. We'll break each one down, and then at the very end, we'll line them all up for the final results to see who really came out on top.
This is the big question, isn't it? The one that this whole thing is built around. It's not about being a millionaire from day one. It's not taking a small, accessible amount of money and finding out how you can make it work the hardest for you. This 4-year test was all about getting a practical answer, based on what actually happened, not just what a textbook says should happen.
Okay, so every competition needs rules, and this bake-off is no different. We're going to be judging our 5 investments on 5 key things. First up, difficulty. Basically, how much homework do you have to do? Second, passive income. Can it make you money while you're sleeping? Third, tax efficiency. How good is it at shielding your gains from the taxman? Fourth, risk. What are the odds you could lose your shirt? And finally, the big one, the results after 4 years. And of course, I have to say it, this is just breaking down an experiment. It is not financial advice. Please, always do your own research.
First up to the plate, we've got individual stocks. This is the classic approach. You're not just buying into the market, you're buying a tiny slice of a specific company that you personally believe is going to do amazing things. It's kind of thrilling, right? Betting on a brand you really know and trust. So how's the scorecard look? Well, difficulty is rated high. And yeah, that's fair. To do this properly, you kind of have to become a detective, digging through financial reports and really getting what a company is all about. Passive income is pretty good, since a lot of companies share their profits with you through dividends. Tax efficiency is excellent. You can often hold these in special accounts, like a Roth IRA or an ISA, where your profits can grow tax-free. But the risk? Oh yeah, it is high. The person who ran this experiment even mentioned their own experience during the dot-com bubble. One stock went to the moon, another went totally bankrupt. That's a perfect little story about risk right there. And the final result for this particular stock pick? Well, after 4 years, the $100 invested in Samsung actually shrank down to just $67.76. That's a 32% loss. Ouch. But here's what's so fascinating. The stock was picked by literally throwing a dart at a list. If that same dart had just happened to land on Nvidia instead, that $100 would have exploded to over $900. It's the perfect example of that high-risk rating in action. It's basically a lottery ticket. All right, next up, contestant number 2, REITs. That stands for Real Estate Investment Trusts. It sounds super complicated, I know, but the idea behind it is actually genius, and it's pretty simple. Imagine you and a few thousand of your closest friends all pool your money to buy a shopping mall. Then you all get to share in the rent that the stores pay. That's a REIT. It's like being a landlord, but without any of the late-night calls about a clogged toilet. So for the scorecard, difficulty is medium. I mean, it's way easier than buying a whole building yourself, but you should probably still know what kind of properties the fund is holding. Its real superpower, though, is excellent passive income. See, by law, REITs have to pay out at least 90% of their profits to you as dividends. Tax efficiency is also excellent, since you can usually hold them in those same tax-protected accounts we talked about. The risk is medium. You're spread out, sure, but if the whole property market takes a hit, you're going to feel it. So what was the final number? The $100 REIT investment turned into $110.52. Now, what's interesting here is the property value itself actually went down a little, but the investment still paid out almost $12 in dividends. This pretty modest result makes total sense when you think about it. This particular fund was full of commercial properties, office buildings and such, which obviously struggled when the pandemic hit and everyone started working from home. It's a perfect example of how the real world can directly impact your investments. All right, let's get to our third contestant, and this one is the total absolute wild card of the entire group: cryptocurrency. For this experiment, we're talking about Bitcoin. Just think of it like digital money that no bank or government controls. And that independence, well, that's a huge part of its appeal. But it's also why it's famous for its absolutely stomach-churning volatility. Looking at its scorecard, the difficulty is medium. There's definitely a learning curve with things like digital wallets and exchanges. You can get some passive income through stuff like staking, but it's not as simple as getting a dividend check. But here is the really, really important part. Tax efficiency is rated very poor. You generally can't stick crypto into those tax-free accounts, which means any profits you make are totally exposed to taxes. And the risk? It's rated very high for a very good reason. This isn't just an investment, it's a bet on a whole new kind of technology. I mean, this quote from the original source just sums it up perfectly. Getting into crypto isn't like buying a piece of a stable company that's been around for 100 years. No way. It's the Wild West, a world with massive, massive potential upside, but also the very real risk of total collapse. You gotta have nerves of steel for this ride. So, after all that talk of risk, what happened to the $100 that was put into Bitcoin 4 years ago? It turned into an absolutely mind-boggling $652.24. That's a return of over 550%. I mean, wow. That is a truly staggering result that just completely upends the entire competition. It's the kind of number that makes headlines. But, and I can't say this enough, this is maybe the most important but of this entire breakdown. We have to put that huge number into context. This result is a massive, massive outlier. Yes, Bitcoin was the single best performing asset of the last decade, but the vast, and I mean vast majority of other cryptocurrencies do not do this. In fact, most of them lose everything and go to zero. So this incredible headline-grabbing result is also the perfect illustration of that very high-risk rating we just talked about. Okay, moving on to contestant number 4. Let's talk about an asset that's been humanity's go-to store of value for, just a few millennia. Gold. This is the classic safe haven play. When people get nervous about the economy or inflation, they often flock to gold to protect their wealth. Gold's scorecard tells a really clear story. Difficulty is low. These days, it's incredibly easy to buy into gold through an online fund. Passive income, though? Non-existent. A bar of gold doesn't do anything. It doesn't pay you rent. It doesn't give you dividends. Its entire job is just to sit there and hopefully hold its value. Tax efficiency is good, since you can often hold these funds in tax shelters. The risk is medium. The price does go up and down, but over the very long term, it's known for its stability. So after 4 years, the $100 investment in gold grew to $140.10. That's a really solid 40% return. Look, it didn't shoot for the moon, but it wasn't supposed to. Its whole mission was to protect that initial $100 from getting eaten by inflation and to grow it steadily. And you know what? It did its job perfectly. This is what wealth preservation looks like. And now for our final contestant, the absolute powerhouse of passive investing, the index fund. Okay, so if picking an individual stock is like betting on a single horse to win a race, buying an index fund is like putting a small bet on all the horses, figuring that as a group, they'll do pretty well. You're buying a tiny piece of the whole market, like say all 500 of the biggest companies in America, all in one simple click. The scorecard for index funds is frankly incredible. The difficulty is very low. This is the absolute definition of a set-it-and-forget-it investment. You don't have to research a single company. Passive income is medium because you get a little slice of all the dividends from the hundreds of companies in the fund. Tax efficiency is excellent. And the risk? Very low. Because you're spread out across the entire economy, if 1 or 2 companies have a terrible year, it barely even makes a dent. So what was the final result for our slow and steady friend? The $100 invested in an S&P 500 index fund grew to an impressive $179.57. That is almost an 80% return. And what's so powerful here is the combination. You got a fantastic return for very low effort and very low risk. It's this beautiful mix of simplicity and strong performance that explains why it's the core strategy for so many successful long-term investors. Okay, we've met all 5 of our contestants. We've seen their stats, we've looked at their 4-year journey. Now, it is time to bring them all back together on stage and see the final results of our $100 investment bake-off. And here it is, the final leaderboard. I mean, the outcomes could not be more different, could they? At the very bottom, our dart throw stock pick actually lost money. REITs and gold gave us nice, steady, positive returns. The index fund delivered a really strong performance, almost doubling the money. And then, in a totally different league, there's Bitcoin, with that just astronomical gain. This bar chart really puts it all into perspective, doesn't it? You can see the respectable, healthy growth from gold and the index fund, but they are completely, utterly dwarfed by that Bitcoin skyscraper. It's a really powerful visual, but it is so important to remember that while Bitcoin won this 4-year race by a country mile, that journey was an insane roller coaster, and it could have just as easily finished at the very, very bottom of this chart.
So, what's the big takeaway from all this? Honestly, it's that whether you're a slow and steady person or a high-risk adventurer, the most important thing you can possibly do is just get started. Even a small amount, like $100, can grow into something really meaningful over time, all thanks to the magic of compounding. The greatest tool you have for building wealth is time. So the only real question left is the one right there on your screen.